In this session, we will learn about a key concept that will help you answer these 5 questions. At the outset, these 5 questions may not be related, but only if you know this particular concept, you will be able to answer these 5 questions. The first question is, let's say if you have a positive expectancy strategy, a strategy that wins, let's say that strategy has a win rate of 60% and a 2:1 reward to risk ratio. Backtest is profitable, but still when you run it live, your account is losing. Why is it losing? If you understand the concept that we are going to discuss in this video, you will be able to answer this question. Second question, every time I trade more to recover a loss, I fall further behind. Why? Third one, I have only 1 to 2 lakh capital. This is the question I get asked the most. Is it enough to trade in F&O? It's definitely not. You will understand why at the end of this video. Props and FPIs make about 60,000 to 70,000 crores every year. So this is FY24 figure. I don't have the FY25 figure yet. They make a lot of money. What are they doing? What strategies are they deploying? Can we actually replicate their strategy? Is it possible? Answer is no. We can't do what they are doing. You will know why at the end of this video. Fifth point, stop loss, risk management, position sizing. I am doing all of these things right, but still my live account is losing. To understand this, you need to know more about the structure of the market that we'll be covering in this video. Retail traders on aggregate lose money in F&O trading. We all know that. So retail traders have lost about 61,000 crores during FY24, and proprietary traders and FPI, they have collectively made about 61,000 crores during that year. Now, how do props and FIs make almost 61,000 crores in a year? If you have to understand this, you need to understand one key concept that we'll be discussing in this video, which will also help you design better trading systems. Now, majority of the money made by props and FIs are through algos. You can see the split here. Prop traders make about 32,000 crores using algos, and FPIs make about 26,900 crores using algos. So that is approximately 96-97% of their profits through algos. These algos could either be directional algos or non-directional algos. We need to identify which one of these it will be. Now, for this, you need to understand the market structure. FIs and props in total will be about 1,000 entities, not more than that. On the opposite side, there are about 1 crore retail traders, and on average, each retail trader is taking a position of 11,824 rupees per transaction, and retail traders are making about 875 transactions per year. Now, crores of retail traders making thousands of transactions in a year, and who is the counterparty? FI and prop are the counterparties, which means that FAs and prop are making profits by doing a large number of transactions and getting small profits from those transactions. And structurally, that is possible only in a non-directional play or a bi-directional play, and it is not at all possible in a directional play. In a directional play, you would ideally be doing a smaller number of transactions and holding your position for a long period of time so that the profit per transaction is high. But this case is opposite. FIs and prop are doing a large number of transactions and netting a small amount per transaction. And this is possible only by market making. And market making means capturing the bid-ask spread. To understand bid-ask spread, choose any instrument. I have loaded Nifty 24th March expiry 23,300 call option. So this option was at the money when I loaded it. Price was around 239.8, which is last traded price. And in the order depth, market depth as they call it, you will see bid on the left hand side and offer or ask on the right hand side. Bid is nothing but the highest price a buyer will pay to the seller. For example, if you want to sell this option and you are selling at market order, you are going to get 239.2. So this is the highest price that you will get. Similarly, if you are going to buy this option, you are an option buyer, and if you are going to buy this option, this is the lowest price that you will be getting. You cannot buy it below 239.7 based on the current order book. Now let us assume that you are buying this option and selling it immediately. So when you buy it at market price, the price that you are going to get is 239.7. And when you are going to immediately sell it, the price that you are going to sell at is 239.2. So when you buy and sell immediately, you will be at a loss of 0.5 rupees. That is 239.7 minus 239.2. That is nothing but the spread. If you keep on doing it, let's say you are buying and selling repeatedly within 10 seconds, you would be actually losing 0.5 on every trade, assuming that the price does not move significantly and you actually execute 10 trades within that time frame, then you will be losing 0.5 on every trade. That is the spread that you are paying to the market makers. Now, this spread as a percentage is nothing but spread by midpoint into 100. What is midpoint? We calculate the average between 239.2 and 239.7. So that is around 239.45. 0.5 divided by 239.45 is nothing but 0.21 percentage. So on every options trade, whether you are an options buyer or an options seller, you are always paying the spread. To understand beta spread better, I put the example of a money exchange in an airport. Currently, USD INR is trading around 93.9. Recently, it has depreciated post the war. If you go to the airport today and if you want $1, you have to pay around 95 rupees. Similarly, when you come back from US, let's say you went on a trip, you bought dollars at 95 rupees at the airport, you come back from US, now you want to give the dollar back. You will get only 89 rupees per dollar. So when you buy above the actual price, and when you sell below the actual price. This 6 rupees is pocketed by this exchange company. Similarly, this 0.5 rupees is pocketed by the market maker. So market makers are basically shops inside the exchange who are enabling your transaction. Your market order is possible because they have their limit orders placed. Now, let me ask you a simple question. Will you go to this money exchange counter 10 times in a day to transact US dollar? You wouldn't do that, right? Even in one transaction, you are losing 6 rupees. If you do 10 transactions, you are going to lose 60 rupees. So you will never do that. When you need the US dollar, when you are traveling, you will buy it. And then when you come back, you will sell it. Done. The shop makes 6 rupees. You got your US dollars. Both parties satisfied. But you will not go to the shop 10 times in a day, which is not required. But in the markets, people typically overtrade. They believe that if they take more trades, they're actually going to end up in profits, which is actually not the case. The more trades you take, the more you pay in bid spread and the more you pay in slippage. We'll talk about slippage in one of the upcoming videos, but you will be paying more and more bid spread. Bid spread is not a fixed cost like brokerage. Bid spread is something which you pay on every single trade. Let me show you a real-time simulation. This is the options trading cost simulator. This is available in our website. In this calculator, on the left-hand side, you will see the inputs, and on the right-hand side, you will see the output. First, you have to enter the strategy details. The capital that you are using, I assume 2 lakhs. Your risk per day, how much you would want to risk per day? 1%. So you are risking about 2,000 rupees per day. What is the risk reward ratio? 2 is to 1. So you would want to gain 4,000 for every 2,000 you risk. And let's assume that you are profitable on 60% of the days. So look at the expectancy of the strategy plus 0.8 R. So this is kind of an ideal strategy. First of all, this type of strategy wouldn't exist in the market. I'm assuming an extreme case, which is an ideal case. And as part of this strategy, let's say that you are deploying 10 trades per day. So what you are doing is you are buying options worth 10 rupees and you are selling it when they go to 20 rupees. Your dealing quantity is 500 quantity. For example, with this 2 lakh capital, let's say you are able to do this, you have an excellent strategy. So on 2 lakhs, you would earn 4 lakhs, meaning 2 lakhs will get converted into 6 lakh if you consider gross profit. So most of the backtesting will suggest that this strategy is profitable. Whatever strategy you analyzed is profitable. But backtests don't typically cover bid spread, cost, and slippage. This strategy would cost you 4,21,000 to execute. When you go to your broker portal, each broker portal would have a brokerage calculator. In the brokerage calculator, they'll show you all these elements: brokerage, STT, exchange transaction charges, GST, SEBI charges, stamp duty, etc. And these charges turn out to be 1,59,000 per year for this particular strategy. Now, gross profit is 4 lakh. Minus this, your strategy should be profitable. They have also given something like points to break even. But this is not the complete picture. You are always paying the bid spread. The bid spread that you pay for this strategy will be approximately 75,000. I have considered the bid spread to be 0.2% per trade. So 75,000 will be the amount you pay for bid-ask spread, and slippage is something you always pay. There is going to be a slippage. I've assumed 0.5%. I'll talk more about slippage in the upcoming videos. So assuming a slippage of 0.5%, you pay 1,87,000 on slippage. Now an extraordinary strategy on paper can turn into a loss-making strategy if you overtrade. If you take 10 trades a day, the strategy, irrespective of how good it is, will definitely be in a loss. And what is the primary reason for it? Bid-ask spread and slippage are the primary reasons for it. To whom does this bid-ask spread and slippage cost go? It typically goes to the market maker and also the person who is able to execute faster than you. So when you design systems around options, it is very important for you not to overtrade. So what are the key takeaways and action points for you? Number one, whenever you do backtest, always remember that backtest hides beta spread, cost, and slippage. You need to add these three to understand whether a strategy can really be profitable post these charges. Most of the time, they are not. There are only very few strategies that still have an edge post beta spread, cost, and slippages. Number two, 1 to 2 lakh capital for F&O trading is absolutely not enough. I would recommend a starting capital of at least 5 lakhs. That too, you have to pledge your long-term investments to trade. You should not keep cash of 5 lakhs to actually trade in F&O. Even if you have a great strategy, you will not be profitable if you trade with 1 to 2 lakhs capital. Finally, more trades is not more opportunity. Whenever you take more trades, always remember that you are donating money to market makers, you are donating money to brokers, and you are donating money to central government and state government. Traders who survive long enough take fewer trades. Whatever strategy you are using, ensure that you do 1 to 2 adjustments per day. That is more than enough. If after 2 adjustments your strategy is in a loss, I think it's time to close the trade for that particular day.